Yep. Thank you, Shane.
Making you the presenter now. All right, take it over.
Okay. Yeah. Good evening, everyone, and thank you, Shane, and thanks everyone for tuning in. Now, on this topic of complementing your investment portfolio with Gold ETF, we will learn a few things. Number one being the basics of ETF and its characteristics, advantages of ETFs, advantage of the Gold ETF, learn the gold market outlook, gold and the ringgit, and the case for gold, and finally learn how investors can complement their portfolio with a gold ETF. Now, basically about ETF and its characteristics. ETFs are the acronym for exchange traded funds. Generally, there are three types of ETFs listed on Bursa, those that track the performance of a basket of stocks, bonds, or commodities. The value of an ETF correlates with the value of the underlying assets. Yeah. This means that the ETF will gain in price as the underlying assets gain in value. Yeah, so they move quite closely to each other. Yeah, and ETFs are similar to mutual funds, except that they can be traded like stocks in Bursa, where the price is live. So sometimes when we invest in mutual funds, I think the most important thing that we realize is that they will take a 5% charge immediately, okay, as a management fee. But in ETFs, when you trade through the Bursa, it's just like using the standard brokerage fees. Okay, you will not be charged, let's say, 5% of the amount that you invested, unlike mutual funds. So that's why sometimes when you invest in mutual funds, not that mutual funds are not good, but just comparing, yeah. Sometimes when you invest in mutual funds, that 5% when they take it off, yeah, it would require the fund to actually gain more than 5% before you finally break even. So that's why that's the disadvantage versus ETFs. Okay, because ETFs you just pay the standard brokerage fees. Okay, then as the stock price grow 5%, the ETFs grow by 5% or 6 or 7%, then you can readily see that profit. But in terms of mutual funds, it has to grow by more than 5% before you are finally able to break even. Now, what are the advantages of ETFs? They provide a means to diversify the portfolio without needing to own the individual stocks or owning the physical commodity. In this case, it's gold. Yeah. So sometimes ETFs, they have a basket of stocks, which are then either they follow a particular index, okay. And in this case, what we are looking at, the gold ETF actually follow the price of gold. Yeah. The fees are cheaper than mutual funds, as I explained just now. Trading is done live, which is unlike mutual funds, and which is based on the price at the close of the day's trading. Now, this could be a disaster when the sell-off happens in the morning and lasted through the day. Okay, so you can just imagine that, let's say you have a mutual fund that track, let's say the ASEAN markets, yeah. But the day before, you already know that because the foreign markets in the US, they have a big crash. So definitely on the next day, okay, you want to sell off whatever, a big portion of your holdings, because you do not want to be caught in a spiral. Because if there's a big crash, you don't know where that particular crash will end. It can be continuous, okay. So in the case of mutual fund, you are not able to sell off in the morning. You can only sell off at the day's closing. So if that is a crash that starts at 5% in the morning, you can sell off, and by the end of the day, that crash could be 20%. And then you suddenly see when you give the order to sell, your holding will actually be reduced by 20%. Okay, but in a live trading environment, using where you buy and sell ETFs, the moment you want to get rid of, first thing in the morning when Bursa opens, okay, you want to sell, you can sell. Okay, then or on the opposite end, assuming that when the market crash, normally when the market crash, people will be very bullish on safe haven. In this case, it's gold. So then you know that because there's a crash, you want to buy the ETF, okay, early in the morning, yes, you are able to do so, okay, and you are able to catch in at the start of the day, okay. So that is how the gold ETF would be able to that ETF would be able to help you get into the game as early as possible. Yeah. So there's also transparency, as each ETF will list the underlying assets it owns, but in this case, it will just be benchmarked against the gold price. Now, what we are talking here is that the Trade Plus Sharia Tracker Gold ETF is managed by Affin Hwang Asset Management Berhad. It's Sharia compliant and is 95% backed by physical gold. Okay, it's very important that when you invest in a gold ETF, you know, they have substantial backing in gold. Okay, and it allows for investors to partake in the investment of gold without needing to own physical gold. Now, this is very important in the case of security. Okay, if you buy physical gold, okay, you will need to have a safe, okay, inside the house to store your gold. And when there's break-in and things like that, then there's always a security risk. So one of the things is that you can reduce your physical gold holding, okay, by moving, you know, into gold ETF, so that your security risk is greatly reduced. Okay, so this ETF also closely tracks the performance of the precious metal in the international market. Okay, and it's redeemable for physical gold at 500,000 units or 5 kg of gold. So unless you have the intention to redeem for physical, but otherwise you can still, you know, partake in the gold market by buying into this ETF. It tracks the performance of the precious metal in terms of pricing. Now,
yeah, it's
gold is money.
If you want to go into that, its ticker is Gold ETF, GOLD ETF. Stock code is 0828EA. Okay, 0828EA. I can share more in the chat group with you all later. So this is the first Sharia compliant which is physically backed, right, by gold. You can redeem it by at least 5 kg if you have accumulated enough. Now the share price is doing at about 1 ringgit 70 over cents per unit of this ETF. So, you know, it is still very affordable to many of you. All right? Yeah. Sorry, just add on a bit.
Sure. Feel free to add on any time. Yeah. Now, one thing is that a lot of people think that gold has no value in the current world because we deal in a fiat currency and so on. And you know, people don't do transaction in gold. But then gold has been money for thousands of years, and gold was first started, you know, although in not in the sense of gold coins and such, but in pieces of gold that have that are of varying sizes. Okay, they first started transacting, okay, about 6,000 years in Egypt. Yeah, so that's how significant gold is. Okay, now gold still holds its significance as money, even as fiat currency became the main medium for trade and commerce. And you can see this by, if you go to the central bank, okay, when there's indication of reserves, okay, you will see that a lot of the banks are actually stockpiling gold. Now, if gold has no value, then why are central banks stockpiling gold? Okay, it must have a certain value, because in the event that fiat currency falls in value, at least gold then could actually retain the purchasing power, and that is why central banks still have a lot of gold. Okay, even Bank Negara itself, okay, have some holdings in gold. Now, until 1971, the USD has been backed by gold. Okay, US dollar up to 1971 was backed by gold, but in that year, President Nixon decided to discontinue the gold backing, and the US went into hyperinflation. Now, because a lot during the after Second World War, in the Bretton Woods Agreement, they allowed the dollar to be backed by gold. Okay, but then because the US went into a lot of costly war after Second World War, they had the Korean War followed by the Vietnam War. So the US have not much gold, okay, to actually meet people demand, okay, that foreign countries, they say, okay, now I want to return the US dollar and I want back my gold. Okay, so that's why President Nixon decided to discontinue the gold backing. And then in his speech, he said the US dollar will be backed by the full faith of the United States government. In other words, it means the US government will continue backing the US dollar through just faith. Okay, and since then, there have been a lot of debt incurred by the US government. Okay, there's also been a lot of money printing. And just to share with you, since 1971, the US dollar has lost about 88% of its purchasing power because of inflation. Now, but then gold from a very low end of $35, okay, in 1971 have reached currently is 1,320. So when you divided that, okay, you can see how much gold has actually appreciated in price. Okay, now if we want to look at going back further into history, since 1913, where the US have the creation of the Federal Reserve, okay, the US dollar has lost more than 97% of its purchasing power. Okay, so that's the huge difference. Yeah. Now this is the gold price chart in US dollar. You can see that this is the period where Nixon took the US dollar off the gold standard. Okay, and you can see, okay, the price of gold actually move up. Okay, because this is a period of hyperinflation. Now, for those who were born in the 1960s like me, we always remember that during the 1970s, there's a lot of advertisement through RTM at that time, telling people to plant your own vegetable, plant your own fruits, because at that time was a period of hyperinflation. And during the period of hyperinflation, interest rate in the US went to as high as 20% interest, okay, at the end of 1980. And during the 1970s, Malaysia itself, the interest rate for FD, believe it or not, yeah, if you hold for 60 months, it's 15%. That's how great the inflation, that hyperinflation is. Can you imagine if FD rate is 15%, yeah, what would be the lending rate? Okay, so the lending rate would likely be around 20 or 20+%. So in a period of hyperinflation, that's why a lot of people have the money, but then they have no purchasing power. Okay, and that's when there will be demand for safe haven assets that retain the purchasing power, and only gold and silver is able to do that. Okay, then we have towards the end of 2008, we have the global financial crisis, and then at the time the Federal Reserve came in and started with QE 1 to 3. QE is actually basically, without going to the detail, it means they printed even more money. Why? Because the US dollar monetary base increased from 800+ billion in 2008, went all the way up to almost 4 trillion US dollars, which means the monetary base has expanded by almost 5 times. So because of that, again, people are fearful of hyperinflation, and they move into the safe haven asset, and gold actually reached its height. Okay, so you can see that over here, okay, some of the gains that the gold have made. From 35 ounce in 1971, it went to 850 ounce in 1980 for a 23,286% gain. Now that's 23 times, yeah. So this is during the period of hyperinflation. Then during the global financial crisis, gold went from US $870 per ounce, okay, at the base, okay, here to US 1,920 per ounce, which is a gain of 121%. Okay, now if we have followed since here to here, then you can roughly work out, there are tens of thousands of percentage in gains. Yeah, so that's how fundamentally important gold is. gold is actually the ideal hedge against a financial crisis. Okay, why? During the 90s depression, gold confiscation by the US government, okay, citizens have to turn in their gold at 35 US dollars per ounce versus the exchange price at that time of US dollars 21. Yeah. So what happened is that the US government say they have a law which forbids citizens to own gold. Okay, and at that time, I think a lot of citizens hit their goal anyway. Okay, rather than turn to the government. Okay, so what happened is that the government willing to pay a higher price to get the gold back because during the depression, the government, they really need the money to keep the economy running again. Okay, then in the 1970s hyperinflation, gold rose to record high as Federal Reserve hiked the interest rate, resulting in the interest rate hitting 20% in 1980. During the 2008 to 2009 global financial crisis, gold hit another new record in 2011 when the Fed went on from QE1 to 3 with low interest rate policy. So we can see that in the depression, hyperinflation, or financial crisis, gold is the ideal hedge. And that is why it's very important for your portfolio, to have some significant amount of gold. So gold, US dollar, and interest rate. Now, there's a lot of misconception over here, about the US dollar and interest rate. Now, a lot of people say that gold is inverse to the US dollar. Yes, it's true, because higher the value of the US dollar, lower the price of gold, because gold is quoted in US dollar. So if the US dollar is very strong, then the price of gold, would likely to go down. Now, lower the value of US dollar, higher the price of gold, because if the US dollar becomes weaker, you need more US dollar to buy gold. But that is not really 100% true. In which case, what if gold is a scarcity? Because currently there's not a lot of gold that are left in the world. Now, if let's say gold is a scarcity, then you will need more. Although the US dollar may appreciate against other currency, but because gold is quite difficult to attain, that's why you will need more US dollar to buy gold. So it's only true to a certain percentage. And what I'm going to share with you later on is that the world is moving towards peak gold and a lack of gold reserve. There are some charts which I'm going to show you, which is going to be pretty interesting. Now, gold is not inverse to interest rate hikes. So a lot of people say that because the Federal Reserve would want to increase interest rate, therefore the US dollar would gain in strength, and therefore gold should fall in price. Now, that is not true. Even some of the economists, they like to relate that interest rate hikes would cause gold price to fall. Now, that is not true. Why? In 2015 December, the Federal Reserve said they are going to hike interest rate. Gold fell before the interest rate hike because everyone was shorting gold. But after the interest rate hike, gold went up in 2016. Then in December 2016, the Federal Reserve said they are going to hike interest rate in December, and a lot of people shorted gold. So in January 2017, gold went up again. So just like in December 2017, before the Federal Reserve hiked the interest rate, a lot of people shorted gold as well. But then now gold is, 1,300 over dollars per ounce. So that is not true. Why? Interest rate hikes because of inflation, and gold is often an hedge against inflation. Now, during runaway inflation, the Federal Reserve or central banks, in that matter, generally speaking, will hike interest rate so that they want to prevent people, okay, from flowing, from moving the money out of the country, because when there is an hyperinflation, people are afraid that the value of that particular currency would reduce. Therefore, they will move their assets elsewhere. Now, if let's say inflation is good, okay, then why is Zimbabwe currently the way it is? You know, the inflation went up thousands of percent, you know, and the Zimbabwe have trillions of dollars in a single note. So if let's say inflation is good, okay, then why is Zimbabwe the way it is? Why is Venezuela the way it is? Okay, and because inflation actually reduced the purchasing power of the currency. So when people say that inflation is good, okay, and then they say that they are going to hike interest rate, okay, and that's why you shouldn't hold gold. Actually, it's not really true. As inflation becomes higher, you should even, you know, hold on to your gold, because that gold itself is retaining that purchasing power, because inflation takes away the purchasing power of a currency. Okay, this is something that you must be very clear. Now, the outlook for gold. When you want to understand gold, okay, you need to adopt a very global view. You cannot just see that how much gold, you know, the Hong is selling, or Huazhen is selling, okay, or even some of the banks when they are, you know, they are selling bullion, gold coins and such. Okay, you have to adopt a very global view. Okay, then you will know what is the direction that gold is heading. And I can share with you, okay, there's a major risk in the horizon, and that is the collapse of financial assets. Yeah. So the money printing by the Federal Reserve, ECB and BOJ has caused asset prices to rise to dangerous level, especially in stocks. Okay, as you know, the global market now is, you know, regardless of whatever negative news, it still continue to go up. You know, it has lost all sense of correlating with the fundamental of the economy. Then you have bonds. Okay, imagine, you know, in Europe, the bond yield is actually negative. Can you imagine? Okay, with negative yield, people still want to buy bonds. Okay, so it doesn't make sense. Okay, it's just like that bank, a bank would tell you, okay, keep your money with us, and every year we will deduct, you know, 3% from your accounts, and that's what precisely negative bond yield is. Okay, so then there's also real estate bubble. In fact, the U.S. Real estate right now, okay, the U.S. Real estate price index is already higher than the 2008 before the mortgage meltdown. Okay, in 2008, it's already higher than that. Then we have Malaysia. You know, property prices have went up a lot, and you can just easily relate. Okay, Australia. Okay, there's a melt up in property price. Okay, and right now they are facing a potential crisis because suddenly the rich Chinese money that comes in to buy the property is no longer allowed, because the Chinese government has banned their citizens from using their cash in China to buy property in foreign countries. And that's what happened in Canada. The stock market, the property market has seen it is now actually crashing. Okay, in Spain as well. Okay, so because of all these real estate bubbles, a lot of the banks in Europe are actually in trouble. Okay, so remember what I said, adopting a global view, and that is what you need when you want to understand the movement of price in gold. Okay, now the world is settled with an unprecedented level of debt to the tune of more than 325% of global GDP. Now, if you try to correlate that, imagine your annual salary is 100,000 ringgit a year, and but then you are settled with 325,000 in debt. Okay, and because of the current, let's say current prevailing interest rate, just servicing that debt, okay, is 18,000 ringgit a year. Okay, so then, you know, from your income, okay, you take a chunk out of the income tax, you take a chunk out for the EPF, and then you take 18%, okay, out of your pay. You know, you are left with very little. Okay, then you have a housing mortgage to then you have other expenses. Okay, so that's why, you know, it's become very unrealistic for government to continue sustaining that kind of debt level, and household, okay, to continue sustaining that kind of high debt levels as well. In the US, total debt is more than 330% of GDP. Now, if you think that 330% of GDP in debt is frightening, the total debt plus unfunded liabilities is more than 900% of the GDP. Imagine the burden of servicing such a huge, okay, debt. Okay, so you can look at, you know, from 100,000, right now you own 900,000. Okay, so your interest then becomes 54%, 54,000. Okay, because 6% of 900,000, okay, is 54%. So your annual salary from 100,000, you are left with 46,000 ringgit, and then you have your EPF, your income tax. You know, it's like totally nothing. So that's why the US is essentially bankrupt. Okay, they are just taking money from the social security and medical care of the future generations to spend in the present situation. And I can tell you that the debt situation in US will escalate. Okay, when the Bush era ended, before Obama became president, okay, the total debt was just 10 trillion. When Obama left, the total debt, government debt we are talking about, yeah, the government debt becomes 20 trillion. And right now, with Trump in the office, already within the first year, we will likely see 1 trillion being added. Okay, so that is how bad the situation is. So central banks high interest rate, the burden of servicing debt will increase, not only to the government, but to the household and public in general who own excessive debts and loans. Now, scaling back of money printing by the ECB and BOJ could result in a liquidity crisis. Now, right now, the ECB and BOJ, they are still on quantity easing, meaning printing a lot of money, but gradually they will not print so much, and then there'll be a tightening liquidity. Now, when there's tightening liquidity, what will happen? Okay, there's nothing to fuel the credit market anymore, and that would cause a potential crisis in terms of financial assets. So, because of the huge amounts of global debt against a backdrop of rising inflation, the next crisis is going to be worse than any we have seen. If you think 2008 was bad, the next one is going to be far, far worse. And it may even exceed the Great Depression. Because can you even imagine the kind of debt that is now, you know, growing every single day? Because governments have no money, they need to borrow to pay for interest. And even worse, okay, in the case of the US, they are borrowing at high interest to pay for loan borrowed during the last few years of quantity easing, where interest rate is near zero, borrowing at a higher cost to pay for loans, okay, to pay for debt that were borrowed at a lower interest. So can you imagine how fast that will escalate? Okay. And also, there's a lot of malinvestment. Malinvestment means poor investment decision, which resulted in the global financial crisis, have not been resolved. Okay, the problem remains to this day. Now, just to share with you, during the global financial crisis, okay, in the US, they have a lot of collateral debt obligation. So when the global financial crisis struck, a lot of these banks which issued those CDOs were fined. So right now, they changed it to another new name. Okay, but the risks, they say, are lesser. But it's still the same. Taking high risk mortgages and loans, split them up into other assets, marry them up, and then they sell it as another alphabetical name, CLO, collateral loan obligation. So it's just like changing, ABC only. So, but then the things remain, okay? So that's why a lot of the risks have not been removed, okay? And the higher the bubble assets grow because of cheap credit, the higher the risks are. And one of the major powder kegs, okay, is the amount of financial derivatives in the world, which is approximately 1.5 quadrillion. Now, what is 1.5 quadrillion dollars? That amount is enough to pay more than US $200,000 per person in the world, including babies. Can you imagine that? Okay. And what if these financial derivatives suddenly go bust? So it becomes even greater than the greatest we have seen, which was the Great Depression. And then the outlook, okay, of geopolitical risks. There are major geopolitical risks, especially in the Middle East, Korean Peninsula, Ukraine, and South China Sea. Any geopolitical risk that resulted in a war could spark a global fear in the collapse of asset prices and push investors to safe havens like gold. Okay, now the US have not much money at all. It's all through debt. If the US embark on any military conflict, they are going to sell more bonds, which means more government debt, which means weaker US dollar, and that will be very bullish for gold. Okay, you can see that almost a lot of war being sparked everywhere in the world. Somehow the US has a finger in everything. Okay, and that's why there's also a report that says for the last few decades since 1980, there's a untraceable 21 trillion US dollar, that the Pentagon cannot trace how they spent it. Okay, so you can think about that kind of money that's being wasted, through war and all those. Now, war could also result in price of commodities rising, pushing up inflationary pressure on economies. So what will happen? Because of a weaker US dollar, a lot of commodities would also start to rise in price, and that would create even greater inflation on a lot of economies. So for Malaysia, okay, if let's say commodities price rise, it could be quite good for us, okay, because we are still essentially very commodity focused, where our income generation is concerned. Now, current political language and military posturing seems to suggest that tension could rise between US, North Korea, and Iran. So what we are seeing is that right now the focus seems to be all around Iran, okay, and I hope it won't happen, but signals to look out for, okay, that potential for military conflict. Okay, if let's say in the Korean Peninsula, if there is any public warning for all non-military personnel to leave South Korea and maybe Japan, then that is likely a military conflict in Korea is at hand. Okay, or if let's say there's a lot of rhetoric that Iran is a state sponsor of terrorism, okay, although they might not have any proof, but remember about Iraq, where they say that there's weapon of mass destruction, but eventually there's none. Okay, if there's a lot of accusation on Iran about sponsoring terrorism, or the discovery of missiles, okay, being linked to Iran, then that could also indicate the escalation, okay, of a risk, okay, of a military conflict. So these are the signals that you can look at. And the petrol yuan. Now, what is happening? Oilprice.com reported on 1st of September 2017 that China would soon launch an oil futures contract in yuan. Here I put renminbi. It still means the same. Okay, to sweeten the deal, according to that report, China may allow the conversion of RMB into gold. in China, they have the Shanghai Gold Exchange, and the Shanghai Gold Exchange is the only exchange in the world right now that deals in physical gold. Forget about the COMEX. The COMEX only deal with in paper gold most of the time. Okay. The LBMA, which is the London Bullion Market Association, deals a lot of paper gold as well as some portion of physical gold. So a lot of the gold normally are based on the closing price of the LBMA. Okay. And when the LBM, and they can claim delivery of physical gold from the LBMA, which the LBMA will honor. But in the COMEX, after they sell paper dumping, a lot of paper gold and so on, you want to claim that gold, they under the COMEX regulations, they have the alternative to pay you in dollars. So which means you will not be able to claim your physical gold from the COMEX. And you can see, if you do a deep enough research, that the Shanghai Physical Gold Exchange in 2 weeks is equivalent to the COMEX physical gold movement in a year. That's how big the difference is. Okay, so that's why the COMEX and LBMA use more in paper gold, but in China, they deal in physical gold. Now, can you imagine that oil exporters suddenly decide to sell their petrol, okay, in yuan, and then so that they can convert that yuan into gold? Now, what will happen? It will weaken the US dollar, and then it will push up the price of gold. Okay, but we do not know whether it's true or not. Okay, although, okay, the introduction of the RMB in oil trade, okay, will start sometime this month. That is according to some reports. Okay, we still have yet to see it becoming a reality. Okay, although there's a lot of confirmation that the Shanghai Futures Exchange have actually tested on trading oil in renminbi, and they have already have the approval of the officials in government. Okay, so the introduction of RMB in the oil trade could weaken the US dollar, as it is the predominant currency in the oil trade. Okay, China, being the world's largest exporter of crude oil, may demand that the oil contract be settled in renminbi. Okay, so China may demand that Saudi Arabia, okay, sell the oil to them in renminbi. But that would, of course, spark US protest here, and that's why if Saudi Arabia do so, okay, then the US could take severe action against Saudi Arabia. Okay, the relationship of US and Saudi Arabia in the oil trade is a very complex one. If you are keen, you can actually do a search on Google and read about the petrodollar agreement, which started during the 1970s. Yeah, it's a very interesting issue where US is able to export their money printing, yeah, to the rest of the world. Okay, but roughly it means that US buy oil from Saudi Arabia get US dollars, but Saudi Arabia must invest the US dollar in US Treasury. And then because of because of Saudi Arabia invest in US Treasury, the US will have the money to continue spending. Okay, and in return, US say they will guarantee the safety of Saudi Arabia. So that is how the petrodollar arrangement is. But coming into this ball game would be the petro yuan or the renminbi, which is going to pit both currencies against each other. Okay, there is likely there's also a likelihood that China might invest in the Saudi's largest IPO, the Aramco oil company, which is the world's largest oil company, by taking a certain percentage stake. Now, assuming that that happens, okay, then China could actually sell oil via Aramco in renminbi. Okay, so whatever that is, okay, assuming that the conversion of renminbi into gold takes place, then you can imagine what will happen to other commodities exported to China, who suddenly sees that, hey, if oil can sell to China in renminbi and they can convert that renminbi into gold, then why not I sell my copper to China and ask for renminbi also? Now, China is already the world largest importer of a lot of commodities, okay, like nickel, I think even zinc, copper and such, okay. So imagine all these exporters suddenly wants renminbi just because they can convert it into gold. Now, that could weaken the US dollar very, very much, okay. So, but we still do not know, okay, but because the oil futures exchange happens to be in Shanghai and the Shanghai physical gold exchange happens to be in Shanghai, of course, then could there be such a conversion? But already China and Russia are already trading in renminbi, okay, for in oil, and also Russia has established, their central bank has established an office in Shanghai, okay, to explore on the physical gold swap and things like that, okay. And China also have an office in Moscow, okay, to deal in renminbi swap. So you can see that there's a lot of things happening between these two countries, okay, which may undermine the US dollar. Now, if the conversion of RMB into gold is allowed in the oil trade, it could send the price of gold soaring, as there's not enough gold to back the oil trade unless the price rises substantially. So this is something that to look at. Whether it's going to happen or not, we do not know. But the chances are there's a lot of things that's happening that is going to be backed by gold soon. Okay, let's look at the physical gold trade. Russia and China are leading the way in a discussion with other BRICS countries, Brazil, Russia, China, India, and South Africa, okay, to set up a new physical gold trade network, citing the irrelevancy of the LBMA and COMEX in the physical gold trade, because they know that the LBMA and COMEX deals in gold derivatives, okay, paper gold, and have been known to suppress the price of gold through heavy short selling. Now, why do they want to suppress the price of gold? Many people believe that it's at the direction of the Federal Reserve, the Bank of International Settlement, because of the trying to maintain the value of the US dollar. Because if the US dollar becomes too weak, then the faith of people in that currency, okay, would actually be impacted negatively, and then there will be a flight out of the US dollar. But no matter what they do, people are already now seeing that the debt in US is unsustainable, okay, and that is why you see Russia and China coming in to preach to the whole world that there should not be a unipolar world, which means there's only going to be the US that is the most powerful, and everyone have to subjugate themselves to the whims and fancy of the US direction. Okay, they are stressing on a multipolar world where all countries can exist together, okay, and they can deal in their own currencies as they deem fit, okay, for the benefit of their own economy. So you can see right now there's a two pole of action. One is in the west, one is in the east. Okay, so Russia and China central banks have been accumulating gold heavily. Okay, Brazil, Russia, China, and South Africa are the world's largest producer, and India is the world's largest consumer. Now, can you imagine if all these 5 countries, they get together? China is, of course, is one of the world's largest consumer as well after India. Yeah, can you imagine if these 5 countries being top consumer and top producer, they have a gold trade that they allow the physical gold to have its own price discovery without suppression? Okay, then the price of gold could really take off, okay? Because people then would be looking at the value of that gold itself, okay? Not the value of the paper gold. Now, this is how the Russia and China gold reserve is, okay? And even Turkey, you know, is moving towards the east of eastern sphere of influence. Okay, Russia has been accumulating at breakneck pace. Okay, mainly because it was during the period of continuous Europe and US sanctions against Russia that Russia changed its game plan. Okay, while US is still mired in heavy debt, Russia is currently, actually at the end of last year, they are able to pay off the entire debt burden of the Soviet era debt. Okay, and right now Russia has very little debt. Okay, and Russia has been steadily accumulating gold, and so is China. But China has not declared their official gold holding very aggressively. Some people think that China actually has more gold than the US. The US have 8,000 tons of gold, but a lot of people say that during the Vietnam War, a lot of this gold has been used up, and the US have it just as a balance sheet. Okay, so a lot of conspiracy theory, but that's another thing. But China itself, okay, there's a lot of gold that moved into China because China is one of the major importers of gold among Russia and India. And China is also the world's largest producer of gold. And whatever gold that's ever produced in China has never left the country. So, you know, for the last 2 decades, I think China is the world's largest producer. Okay, China cannot just have 1,600 plus tons of gold. Okay, that's why a lot of people are not buying it. That China has less, so little gold in their reserve. Okay, so you can also see that there's now a lot of change in the geopolitical sphere of influence. The Eastern Bloc, you have China, Russia, and right now Iran. Okay, and what is happening recently? In the March of last year, Iran actually announced that they would stop dealing all trades in US dollar. Okay. Russia, I think around the Q3 or Q4 of last year, the president of Russia, Putin, okay, issued an order that all Russian ports that deal in trades shall not use the US dollar. Okay, and of course, China is very silent. Okay, but you can see that there's a lot of underlying things happening in favor of the RMB, the renminbi. First and foremost was, I think, in early 2017, the IMF has issued an SDR bond. Okay, SDR is the IMF's so-called currency, which is redeemable in renminbi. And just as recently, Russia issued a $1 billion bond, but is redeemable in renminbi as well. So you can see that, a lot of movement now is towards the eastern side. And Pakistan also announced that they are going to have bilateral trade in renminbi. Okay, and Venezuela is already stating that they will use the oil trade in renminbi. So if you have all these, top producing countries, Russia, Iran, and Venezuela, opting to use the renminbi for oil, okay, then, you can see that whatever that previously was in US dollar has now been taken out. Yeah. So the other thing I want to share with you about peak gold. Now, there are a lot of reports which indicate that we are approaching peak gold. Peak gold means that, gold have reached a certain peak, and therefore whatever that happens in the next years, okay, will be a fall off in terms of production. Now, these are some articles like gold prices to rise sooner than later. CEO warns that production will not meet demand. That was in a Bloomberg report. Stuart Thompson, which is a gold-focused analyst, says that gold exploration is not resulting in viable new mines. That was in silverdoctors.com. Okay, so whatever exploration that they discover is not commercial viable because at the current price of gold, that any company that invests in that gold mine would certainly lose money. Okay, Peak Gold Australia edition, the land down under in serious trouble underground. Okay, this is another silverdoctors.com. Peak gold is an understatement. Chinese gold mining supply is down 10%. Again from silverdoctors.com. Now, if China is the gold largest gold producer in the world and gold supply is down 10%, you can see that it's going to impact on the China's accumulation of gold. So what they will do for this shortfall in 10%, they will buy from the international market, okay, because China has a gold policy, okay. Now, all these reports seems to suggest that the demand could overtake supply in the near future, which could be bullish, which could be a bullish indicator for gold. Now, this is the peak gold price chart, okay. So what a lot of the reporter in Bloomberg is expecting that it will peak somewhere around 2018 or 2019, and then it will just start to fall off, okay. Now, if a crisis happen in any time during here, the rush for safe haven asset, okay, for gold, and you have a continuous falling of gold production, then that is going to be another factor that will push up the price of gold even higher. And then we have the gold miners reserve. Now, every mining company, they need to state their reserve. Like every oil company, they have their own reserve as well as resource indicator. It's no different in gold, okay? So you can see that gold reserve since 2011, okay, has actually been falling. Because during this period, gold reached a peak in 2011, and all the price suppression that happened all the way until 2015 is gold actually had a 4-year bear market, okay. But then if let's say gold has a 4-year bear market, why is the gold reserves falling? That's because countries like China, Russia, okay, India, all these countries that value gold, they were buying gold in a frenzy, okay. It's just like that's not enough gold for them at all. They just keep on buying and buying and buying. Whereas the Western bank continue to sell gold, okay, because they deem that the gold has lost favor. The Eastern Bloc are actually buying gold at a frenzied pace, okay. Now, is the Western bank correct? Or the Western, is the Western Bloc correct or the Eastern Bloc? Well, definitely for sure, I will stand in favor of the Eastern Bloc on the importance of gold, because what I see on the Western Bloc is just that the currency is backed by that. And in the Eastern Bloc, although they did not officially announce that, you know, their currency is backed by gold or whatsoever, but I know that what that country have in their reserve is something of value. And because of this frenzied buying, a lot of the gold have actually moved from the west to the east, okay. And just as indicator why the Western banks have not much gold. Number one, when the Bundesbank in Germany, I think was around 2016, they told the Federal Reserve, we want our gold back, 500 tons of them, we want it back, you know. Then the Federal Reserve say, no, you can't have your gold back immediately, but we will do it over 2 years. Then you need to ask, if let's say they already have the 8,000 tons of gold there, what's so difficult in giving back what Germany wants, which is the 500 tons of gold which they kept with the Federal Reserve? They want it 2 years instead. So that goes to tell you, indicates that they don't really have so much gold as they say they have, okay. Another thing, a few cases, very interesting, highlighted in another news channel, that some wealthy people in Switzerland went to the bank and said that they want to take back their physical gold. That bank actually was UBS, if I'm not wrong. They say that no, you can't have your gold back. Then the person say that, well, can you give me your um, your official statement so that I can make a police report? Yeah. So you can see that because they do not have that kind of physical gold available on the Western. That's why right now in the Swiss refinery, which is one of the best refinery in the world, okay, if you want to buy physical gold on a big amount, you have to pay a premium. Not it's different, you know. The price of gold per ounce never change, but if you want to buy millions of ounces in physical, that price is many times a premium. Why? Because that's a backlog. Okay, and whatever gold, okay, in the western side is actually on 10-ounce bar. When it moves to the east, it's actually in 1 kilo bar. So and east never move their gold out to the Swiss refinery to be refined. All the Swiss refinery can say is that they are actually refining 10-ounce bar into 1 kilo bar, so that you can see that that gold is actually moving towards the east. Now, exploration, failure in exploration, yeah. Amount of gold found by miners have plunged 85% over the past decade. Even as new mines are discovered, it takes many years from planning to eventual production. It is also capital intensive and subject to available financing. Now, if gold price remains low, who will going to finance a gold mine? To start a gold mine, you know, from the initial stage of getting that block of land to the final completion of that mining facility, including a production facility, could easily take 6 to 8 years. So when you see that exploration is failing, okay, and then you have a lower reserve, okay, and you have supply dwindling among producers, what does that tell you about the future of gold? Yeah. So why the portfolio needs to diversify into gold? Global financial risks have risen exponentially. Geopolitical tension in the world have also risen considerably. The US dollar is being challenged by countries adopting to trade in local currencies, not only just among the few countries here. You will be surprised that the eventual completion of the Belt and Road Initiative that China started and very supported by Russia, because Russia still have good connection with a lot of the Central Asian countries, all the Tans, yeah, Kazakhstan, Turkmenistan, all the Tans family, okay. They have actually very close connection with them, and very likelihood they will also adopt a trade that is based on local currencies, majority focusing on the renminbi rather than US dollar. Okay, demand for physical gold expected to pick up through the Russian and Chinese initiatives. Okay, supply will fall short of demand in the next few years. Now, this is why you need to diversify your portfolio. Let's talk about gold and the ringgit. Now, at its height, the gold to ringgit pair reached 5,700 ringgit per ounce, okay, on September 3rd, 2017, okay, when gold was just $1,335 per ounce, yeah, based on an exchange rate of US dollar equivalent to 4 ringgit and 27 cents then. When gold hits its high at 2011, the gold and ringgit pair was 5,000 ringgit, 655 per ounce, okay, which is $1,908 per ounce on 22nd of August 2011. At that time, $1 is equal to 2 ringgit and 96. Can you see that despite a lower value of in US dollar, but because the ringgit fell to 4 ringgit and 27 cents, you know, it reached 5,700 ringgit, more than the ringgit worth when gold was at its height at $1,900 per ounce. Now, this is why gold is an excellent. Sorry, I need to do some change here. Page. Okay. Okay, and we are back. Okay, it's an excellent hedge when the ringgit is weak. So sometimes, you know, your investment, you should not just look at an investment that just can gain money for you. Okay, that is important. An investment should gain money for you, but an investment should also, you should also have some type of investment that work as an insurance policy for you. Okay, because if everything is geared towards growth, okay, what if there's a crisis? And when you invest a lot into growth companies, their growth will definitely fall and your portfolio will be very badly impacted. When you have a portfolio that is an insurance, okay, it may not show any growth within that, few years when the economy is good. But when that economy is bad, this insurance policy is something which you can cash out and then buy other stocks when their value is at the lowest. So because one of the thing is that when people just invest in just looking at gains in the stock value, what happens when the market crash? What's your insurance? You need to ask yourself that. Yeah, all of us, when we, even as we work, we also make sure we have an insurance. What if, okay, something bad happened and for long periods of time we are unable to work? That's when the insurance will help you. Now, when you relate that into your portfolio, your employee is money. Money is working for you. Okay, your portfolio is working for you. Okay, your portfolio is your employee. But if you do not have an insurance for your portfolio, what if a market crash and your portfolio get devastated? How are you going to rebuild back your portfolio within the shortest time possible? Are you going to wait until the next 2 years, you retain back 50% of your value, then 100% of your value, and then you sell to recoup all your losses? So that's why sometimes investment doesn't mean you must have every single investment that makes you money. Some investment are there just as an insurance, but when a crisis happens, you cannot say that crisis will never happen. Yeah, I mean, in all the times of economic problems, when there's up, there's always down. There cannot be one straight line up. Okay, that will be defying the natural laws of economics. Okay, so that portfolio, that investment that you have may not be helping you to make any money. But imagine when something happens, you cash it out as an insurance, it gives you the wealth for you to make even more money in the future. Okay, now the case for gold. Many economies have voiced their concern over the record global debt and easy monetary policy. According to Jim Rickards, the next financial crisis, which is around the corner, could send gold up to $10,000 per ounce. Well-known trend forecaster Gerald Celente has also put the price of gold at $10,000 in the next financial crisis. Famous writer and gold investor Mike Maloney wrote that gold needs to be at US 20,000 an ounce to put global debt back in a clean state. And we know how bad global debt is. Yeah. So these are well-known people in the gold industry. Yeah. They have been advocates of gold, not because they want to promote gold, but they actually want people to have protection against a potential crisis. Yeah. So how can a gold ETF complement your portfolio? We base on assumptions that you allocate 10% of the funds into a gold ETF, balance of portfolio of 90% into shares. In a financial crisis, your portfolio of shares will fall by 50%. Now that is what happened in the last financial crisis. If we go back to the Great Depression, okay, the Great Depression stock prices actually fell 90%. And right now, what the amount of debt, the kind of situation we are in, is equivalent, if not worse, than the last depression. Okay, so that's why we are taking an average. Okay, that stock market would fall by 50%. At 10,000, okay, dollars per ounce, it is 7.8 times its current value. Okay, at that time when this was being done, it was at 1,270. Right now, it has gone up maybe about $40. Okay, that's 7.8 times current value. Your portfolio now is valued at 45% because out of the 90%, it fell by 50%. So you are left with 45%. But assuming in the next crisis that gold holds true to the value projected by all those key persons that I mentioned just now, you add that 78%. Okay. Sorry, some miscalculation here is actually 1, 2, 3. Okay, you still get 123%. So your portfolio gains by 23%. So can you imagine that in a financial crisis where everyone is seeing devastation in the portfolio, you are still able to escape up with 23%. Isn't that good? So that's how this insurance will come into play. Now, let's say that gold didn't reach $10,000. It reached maybe half of that. Now, even half of that is 3.9 times its current value. So your portfolio is now valued at 45% plus 39% is 84%. So when everyone's portfolio suffer, 50% drop, you just suffered a 16% loss. So can you imagine? Those people who suffered that 50% loss have to wait until their stock go back to their previous price before they want to sell, or they have to force sell with a loss. But then you still can cash out that 39% of that portfolio, and you have 39% now in cash for you to buy stocks at a much lower cost. So that is how a gold ETF works as an insurance, which allow you to cash out during a crisis and buy shares on the low. Now, some parting words before we end. This is by JP Morgan, the founder of the JP Morgan Bank. Gold is money. Everything else is credit. Okay, Q&A session.
Okay, that is such an excellent sharing from our speaker, PC Wong, okay, who is quite an expert in the gold and silver industry, precious metal industry. And I think just now PC has shared with you the outlook for gold and why he thinks that gold will appreciate. And in fact, I agree with most of the points that he said, and that's why I'm very bullish in the precious metal market as well. So if with all this information about or this outlook about gold and gold market, I think one of the action that you can take is to choose to diversify some of your portfolio into the gold ETF that was recently launched by the Afin Huang. And then that's where you can easily buy into gold and silver without thinking where you can store your gold in the storage. And this gold ETF that's physically backed, so which is relatively safe. So I want to compliment that Afin Huang for putting off such a great fit into making it the ETF for the retail investor. All right. So if any questions that you have for us, then you can put it down in the question and answer. All right. So now, first question is the gold affected by the speculation or is it resistant? Is there any resistance from it?
You need to look at gold on a like I say, on the long-term possibility, yeah. Because on the long-term possibility, we know that lesser new gold mines are discovered, and even new mines discovered, they are not commercially viable at the current price, and also that the supply of physical gold is actually shrinking among the mining companies. So that is you have to adopt a long-term perspective. Now, the other perspective that you need to look at, like I say, you need to look at the gold ETF as an insurance policy. Do not look at it as able to help you immediately to generate capital appreciation. Although as the US dollar continue to weaken, which I think it will continue to weaken in the coming years, that price will gradually appreciate as well. But look at it as something that you can really help to protect your portfolio.
Okay, now the next question is by Roy, which asks about which website is the most accurate benchmark of gold price.
I think there are a few you can look at. Some of them, they are based on the spot price. Okay, some of them is based on the trading price, because the spot price is normally more higher price than the trading price. You can look at certain websites like investing.com. Okay, they have a lot of things on gold. Okay, if you want news of gold, like I mentioned, go to silverdoctors.com. But some of them, they are very pro gold, so you need to take it with some with a pinch of salt. Don't believe everything that they say. Sometimes it's overhyped. Okay, so but the clearest data, maybe you can look at the World Gold Council. They also have a website that details to you the price of gold. Okay, so these are the websites that you can look at. Okay, if you want to know the importance of gold, go to YouTube and look for Mike Maloney, where he teach the audience about the hidden secrets of money. So there are 7 episodes. I also learned a lot from there. So I will encourage you to go to that site, that 7 videos to learn more why gold is important. Okay.
Oh, okay, excellent. So which one is the most accurate one? Which one do you usually see?
I normally use investing.com now, but it can vary just a few dollars, because the investing.com, they have a panel where you can actually look at bonds as well as the US dollar index. So it's together.
Okay.
So then you will know whether the US dollar index is up or down, which can influence the price of gold. Okay, but the World Council is just give you the price of gold. They don't correlate it with anything. So normally I refer to investing.com.
Okay, now if there's a problem with creating excessive fiat currency like from the US, where the result is higher inflation, so the question is the reverse better?
The reverse is definitely, it's not going to be better. Few things, because all the money printing is like a heroin addiction. Yeah, a lot of the companies and a lot of the banks, is like an addiction for a lot of those people who invest in the stock market. Now, if that person is really a heroin addict, you take the heroin out, put him in cold turkey, what will happen? He suffers, isn't it? So that's why if you take the liquidity out, the market crashes. So right now, there's a lot of talk by the Federal Reserve that they will do quantity tightening, reduce their balance sheet so that they pull liquidity out from the market. But so far, the evidence show they are slowly pulling out, not meeting their actual target, which means that they are very worried. Okay, so just to quote Ben Bernanke, the Federal Reserve chairman, ex-Federal Reserve chairman before Janet Yellen, he did once say, the efficiency, how the Fed works the market is 98% talk, 2% action. Okay, so the Fed always talk things up, but actually it may not happen at all. So that's why, now one thing, if the Federal Reserve, they tighten the money, they pull money they pull the liquidity out of the markets are going to crash. And because they worry that the stock market will crash, they will do it very slowly. But because the more they do it slowly, the less confidence people will have in the Federal Reserve, and therefore US dollar will fall. Okay, if they pull out to bring up the value of the US dollar, then the whole market will fall, and they have to print even more money to boost the market up. So that's why now we have reached a situation where do will die, don't do will also die. Okay, so that's how bad it is.
Okay, there's a good analogy by using heroin, and that's where because verbal intervention don't cost money, so
yeah.
the rest of the intervention really cost real dollar and cents.
Yeah.
So anyway,
the talk right now is die sooner or die later.
Okay, so the next question is, since the next crisis will be anytime soon. How shall we as an investor protect our investment, or how shall we allocate our money into different asset class in terms of percentage? I think just now you just answered this question in your last slide.
Yes.
This was
Yes.
asked in the
Yes.
earlier. So
Yeah.
okay, now the next question
I would like to add that if the situation becomes worse, you can gradually increase your exposure to the gold ETF.
okay, now
Let's say from 10%, you can actually
yeah,
move it up to 15%.
yeah. I personally I have more lah. I have more percentage in the gold and silver ETF. So anyway, that's my preference. So next question is the price of this ETF pegged against global gold price?
Um, according to the notes, it's backed by gold, and it follows the price of the international market. So
Under
it's not
LBMA.
pegged. Yeah, the
Follows the
LBMA.
Yeah.
Yeah, it follows the LBMA. Okay, it doesn't mean that peg means it's fixed. Okay, it follows how the price go as it move along. Sometimes peg it means that either within a fixed rate or a very loose peg across a bandwidth. But this is backed by physical gold and follows the price of gold. So it's to a certain extent it's not pegged in that manner.
Yeah, it follows it tracks closely. It's not pegged, like it tracks closely. So the word is used wrongly. So it tracks the price of gold. So if the gold price rises from $1,300 per ounce to $5,000 per ounce, then the ETF price and the NAV will likely to rise by 3 over times. Okay, it will follow I think the fund manager of this ETF will do whatever they can to closely monitor and track the price of the gold.
Yeah.
Okay, so
normally the difference between the ETF and the NAV is very small percentage. That's not a huge difference.
yeah, because the institution will arbitrage the price difference. Okay. So now the next question is, what do you think will happen to the gold ETF if the ringgit appreciates?
Now, if the ringgit appreciate, okay, what will happen is that it will be due to a weaker US dollar. Okay, gold price would actually move up. Okay, then that ringgit value, okay, may not reflect a huge difference. Okay, but if let's say US dollar uh, weaken very fast, okay, then the gold price will actually move up, but then the ringgit will also move up in tandem. So, but then at a certain point, if I doubt that the ringgit will actually move up in the same rate as gold, because certain economic functions would come into being, because a very expensive ringgit will definitely impact our export. So I would assume that up to a certain stage, Bank Negara will step in and help bring the ringgit lower before it impacts our economy negatively. But then gold, in that sense, will still continue to move up higher in a depreciating US dollar.
Okay, so the next question is, if the US government is raising debt by raising bonds, where the US Federal Reserve is the largest buyer, assuming that the US government pays off all the debt, who will be the Federal Reserve pay back the debt to?
First thing, the US dollar, the US government will never be able to pay off its debt. So that question cannot, no point to answer, because as I shared with you, 900% in debt,
against GDP.
Of debt over GDP. Yeah, it can never happen. Okay, it will just continue to print and print and print. Especially right now, with escalating interest rate, the debt repayment interest is going to go even higher. So that's why if the Fed continue to hike interest rate, okay, debt becomes higher, US dollar becomes weaker. There's no end to it.
Okay, so the next question is, how about we hedge with the cryptocurrency? Like gold seems too old school.
Well, at the end of the day, would you want to have a steady asset or a volatile asset as an insurance? Okay, now let's say just when you needed that insurance, okay, and that insurance company tells you, we don't have enough money to fund your insurance. Do you mind, instead of I paying you the whole lump sum, I spread it over 5 years? Okay, this cryptocurrency is just the same. Okay, assuming that just when you needed money most, cryptocurrency also falls. Then, do you want to hedge using a steady and proven hedging instrument, or you want to have a hedging instrument that is volatile? Because just when you needed the money, is not there is not available for you because it also fell. So that's why, when you want to look at hedging your portfolio, look at it, okay, on having something that is steady, okay, and proven, and that is gold.
All right. So the next question is, there were experts encouraging gold investment when the price was $2,000 per ounce, and now it's $1,003, and gold is not paying dividends. So how can the non-paying dividends asset be included in the investment portfolio?
As I say, okay, don't look at your investment in a gold ETF as the ultimate investment for capital appreciation. It has to be taken as an insurance, okay, point of view with gradual capital appreciation. Okay, now I can tell you that what happened when gold was reaching almost 2,000 US dollar. During that time, the Bank of International Settlement, okay, came together with all the bullion banks and said that we need to suppress this. So that was a heavy dumping of physical gold into the market. Just now the chart which I showed you, see whether I can go, that shows the decline in supply of physical gold among the miners. Someone has been buying them. Okay, so what happened was, at that time they worried that gold would actually shoot up even higher and the fiat currency can collapse. And that is why you have all the bankers coming in to suppress the price of gold. But price suppression can only last so long, okay? Because right now, there have been, in the last 3 years of the Federal Reserve hiking interest rate, December 2015, 2016, and 2017, they have thrown in tens of billions of US dollars of paper gold to bring down the price of gold. And look at it, the price of gold right now. In December, during the first heavy shot, gold was at $1,040. Right now, it's 1,320. So what is this telling you is that they have no more physical gold to dump because they have been dumping it since 2011. Okay, so the physical gold dump also happened in 1980. That was when, again, instituted by the Bank of International Settlement, okay, and they dumped the first big load of gold in 1980 to actually bring down the price. So all this movement of gold actually see gold moving back to the east. And right now, the Western banks, okay, have not much physical gold left. That's why you see that the price of gold, has held steady. So you always look at gold as something that is an insurance. That's why I don't recommend that you have a very huge exposure in gold in that sense. Okay, because in times of economic growth, that portfolio may not generate the kind of returns. Okay, but in times of crisis, then you can actually see it. So if you think that if those people who bought at 2,000 they now suffer, then now at this price you should be buying. Okay.
Yeah, maybe you should. So the next question is how to buy into Affin Hwang Gold ETF. Can I trade it like normal stock in our Bursa stock exchange? The answer is yes. ETF works like how you buy stocks. Okay, you can buy it through your broker, any investment bank or securities firm that have a license with the Bursa Malaysia. You can just trade it as usual, like you trade the stocks. Okay, the next question also on the whether the Gold ETF is something similar like a stock warrant that it tracks the mother share. I think it's very similar lah. Okay, like stock warrants also track the mother share. Gold ETFs track the gold. If the gold price go up, gold ETF would likely to go up. So next question is it will it be low volume since it's a new ETF or not? I think I have just recently checked. I think on average they have daily about 500,000 transaction. Okay. Yeah, PC, what you want to add?
Yeah. If it is low volume, then that's the best time for you to accumulate, because when you start accumulating in a crowded trade, the price is going to be very expensive. So normally, if you want to start accumulating, whether it's stocks or ETF in this sense, okay, when the volume is low, means that there's little price movement. But when it becomes a crowded trade, then the price will actually move up very dramatically. So the best time to accumulate is during low volume sessions.
Okay, the next question is, given the strengthening of ringgit, is this the right time to buy gold? Since gold prices are quoted in US dollar, investor would incur currency loss due to appreciation of ringgit versus the US dollar.
Now, if you look at the short and medium term, appreciation of the ringgit may see some slight loss. But like I say, what you are looking at, okay, is an insurance. Just like you keep on paying insurance. Do you use your insurance? You don't use your insurance, but you are okay if you put in money every time, okay? You hope you won't be able to exercise it even, because that means something bad happened to you. But in a gold ETF, you just have to adopt that kind of psychology that it is an insurance. So you accumulate during when the price is low. Okay, don't expect any immediate capital appreciation because you are just allocating a small percentage. When you see it as an insurance, don't look at it as immediately giving you that capital appreciation. Then you have to change your psychology in that. Okay, because when any crisis that happens, then this insurance kick in will be able to deliver to you that needed income for you to start picking stocks at very low value. Okay, so you have to change your psychology. Now, if let's say there's a crash, what will likely to happen? I don't think the ringgit will actually go up in value, because suddenly everyone will want to loosen monetary policy because they want to stimulate the economy. So while you are buying now, it may look in the short term, wow, ringgit appreciate again, so my value in this ETF actually dropped. Now, all the while you've been paying insurance, have you ever actually complained you never get cash out? So you have to adopt that kind of psychology, right? So that is why if you start accumulating now, there'll be slight percentage of, but when there is a crisis, every bank will actually be loosening their monetary policy. Okay, and when every bank loosen the money policy, there's only one asset that will go up, and that's gold.
Okay, now we have come to almost the end of the Q&A sessions, but I just want to quickly summarize it because there are still a few more questions. So for question asking about what is the fee of the ETF that you should be aware of, it trades like a usual trading fee, except one good news is that I think this year the government has waived the stamp duty for ETF and structural warrants, so you don't have to pay stamp duty for ETF, if I'm not mistaken. So secondly is which gold ETF is it tracking? This gold ETF is tracking the gold price on London Bullion Market, LBMA, okay, on the London Bullion Market. So it's tracking.
If I'm not wrong, normally it's at the 3 p.m. close.
Yeah, it's at 3 p.m. close. So and last question is, does this gold ETF give out dividend? The answer is no. It is no income distribution for this gold ETF because gold can never give you dividend. If gold can't give you dividend, of course the gold ETF can't give you dividend. So that sums up the rest of the questions that we are yet to answer. So with that, thank you so much for spending your time with our Bursa webinar. Complement your investment portfolio with Gold ETF. Personally, I am very excited for this launch, and I look forward to sharing it more with investors across the nation to see how they can participate in this Gold ETF. Right, PC can go to the last slide. So if you have any questions, you can if you have any question relating to the Gold ETF, you can also write to PC with his email. PC, you want to move to your last slide? Click to your last slide, alright?
Yeah.
So yeah, you can write to him. Just click.
Yeah.
Yeah, it's wpoichee@gmail.com, alright? So, yeah, thank you so much for joining this webinar organized by Bursa Malaysia and managed by LifeChamp. And my name is Shen Chu, I'm the moderator of this. And thank you so much for tuning in. I wish you pleasant rest of the evening. Thank you and good night, everybody.